Hi, I'm James Robinson. I manage money, and this is my stock pick of the week. Today we're going to talk about the company BHP. So whenever I review a company, I look at the company through 5 categories. The first thing I do is a video on the overview of the company. That's just basically the fundamentals. Then I take a deep dive into the operations of the company, another one into the debt. I look at the safety of the dividends, and finally I look at the company's wealth creation characteristics. So I define wealth creation as the job the management does of enriching the shareholders. There's a number of tools a management can do to achieve that. So a company makes profits and the company could pay us those profits as dividends, that enriches the shareholders. The company could buy back stock, that indirectly enriches the shareholders because I will own a larger percentage of the company after the company has bought back stock, and I'll make likely more earnings per share on the same amount of revenue because there's less shares to divide that by. So that's good. The next thing that they could do is they could pay down debt. That makes my company worth more money in terms of a net worth. It also is likely to increase earnings because we're spending less money on interest. The company could save the money in cash. That builds a buffer for future issues and ability to expand the business, to buy subsidiaries, buffer in case the economy goes bad. So those are the kinds of things. The other thing the company could do is they could reinvest those earnings back in the company. And in theory, if they do that, that should make some money in terms of generating new profits for the company. That's the whole point of reinvesting, after all. So really what we're saying is, in wealth creation, that's the job of the company, is to make the shareholders wealthier. And we want to look at, well, is the company actually achieving that? What are they doing with the profits? And how are those profits benefiting us, the shareholders? And so that's what we're going to talk about. So the first two we're going to talk about is simply the shares outstanding. Is the company actively buying back shares? And if so, are they doing it to a very large degree? And you can see here that yes, BHP has been buying back shares. Looks like they've gone from about 3.2 million shares to about 2.5 million shares over 20 years. So if you had bought the company 20 years ago, you'd own a significantly larger percentage of it today through no investment of your own. That's a good thing. We like that. They don't buy back a ton of shares. This isn't a big tool for this company to enrich the shareholders. As we talked about in the dividend section, they pay a 12% dividend. So they're giving us the money directly back versus buying back shares. But it's amazing that on top of giving us that massive dividend, they are also buying back shares. So that's really, really good. Those two things working together are really fantastic in terms of enriching us, the shareholders. Having said that, there's an interesting picture here when you take a deeper dive in the buying back of shares. So if you had bought 10% of BHP stock 10 years ago, you would have bought about 275 million shares. Today, through stock repurchases, your 275 million shares would mean that you own 10.89% of the company. So you've had about a 9% increase in your ownership in 10 years through doing nothing. And that sounds spectacular, but there's a problem to that. Your shares in the company's earnings would have gone from $2.3 billion. So if you'd spent the money to buy 275 million shares of the company, those earnings that would have accrued to your benefit as a beneficial owner of the company would have been about $2.3 billion. However, in the last 10 years later, your shares in the company would be generating about $1.2 billion over the last 10 years. So I want to talk for a minute about what happened here. And by the way, in terms of earnings per share, the earnings per share went from $8.58 to $4.47. So I want to talk about what's happening here. BHP is a commodity company. And 10 years ago, their commodities were fantastically valuable and they were making money hand over fist. Today, they're a very good company and they're making good money on their copper and their gold and their molybdenum and potash and all the things they mine, but they're not as valuable as they were 10 or 11 years ago. And so the company's earnings aren't as good as they were 10 years ago. That's okay. I didn't tell you to buy the stock 10 years ago, and I wouldn't have. The earnings were so great then and so high, and the cycle was at its peak. I never would have told you to buy it back then. But if you had, that's what would have occurred. And that's one of the problems with owning these cyclical companies over the very, very, very long term, is you're going to have these periods where you have these massive booms and then you have these, downtimes. So be aware when you look at a BHP, whenever you look at a commodity-driven business, you're very likely to have these swings. I mean, imagine oil 10 years ago, you were getting killed in oil, and today oil prices are through the roof and you're making money hand over fist. Just understand that about these industries. And the idea is to find a period of time when you think that a commodity company isn't at its peak and to buy it then, and then to be aware that when it's too good to be true, it's probably too good to be true, and it's time to take your money and go invest it someplace else. But those are the facts in terms of the stock buybacks over the last 10 years. Yes, you own a larger percentage of the company, but it wasn't as good a company. But if you'd have bought it 20 years ago, you'd own even larger percentage of the company, and it's a very good company. So it depends when you buy it, right? So stockholders' equity, obviously we would prefer that the stockholders' equity is going up every year. That's not really what's happening here. First of all, just by definition, stockholders' equity, you take all the assets the company has, you subtract out all the debts and obligations the company has, and what you're left with is the number that's left over is the stockholders' equity. And in theory, you would like to see that going up and to the left, up and to the right every year, right? And you see that it really did that between 2004 and 2013. But since 2013, stockholders' equity has dropped, and it's dropped significantly. And so the question is, is that okay? Well, again, we've talked about this company bought back 10% of the company's shares. This company pays a 12% dividend. That comes at a cost. You're not going to be able to pay out that much money to shareholders and continue to retain all kinds of equity. And so what they have said is we'd rather enrich the shareholders directly rather than having a bunch of money on the books that we don't need and we can't use. So ideally, again, you'd like to see stockholders' equity going up and to the right. But if you have solid management, one of the things you care about is return on assets or return on investments. And if you can't use that equity and those assets efficiently and profitably, then you have no business holding it as a company, and you should be giving it back to the shareholders, which is what they're doing. There's no loss of stockholder equity because they didn't make a profit. There's no loss of stockholder equity because they had bad loans or anything else. The equity has just been paid out to us directly. And so while you see that number has gone from 80 billion down to 30, 55 or 60 billion, don't worry about that, because that money that's no longer there is in your pockets as the owner. And so you should like that fact. Just real quick, this slide looks at shareholders' equity per share. Obviously, the shareholders' equity per share over time is looking better than the shareholders' equity because the same amount of equity is being divided up over 10% less shares over a 10-year period of time. The difference is not very significant on this slide. With some companies, it's big because they're buying back a lot more shares. But the difference isn't that big in this company because they're not buying back a ton of shares. They're only buying back a few shares. But that's what this slide's talking about, and that's why I show you this slide. So return on assets is, to me, a very, very important measure of a company's performance and a management's performance. All return on assets is how much profits did you make and how much money and capital did you have to tie up to make it. So all of the assets this company owns, every dump truck, every drill bit, every computer, every penny that they've got in the bank is their assets. And that's what they're utilizing to run the business. And I don't mind them doing that, but I want them to do it as efficiently as possible. And the way we measure that is by measuring the return on assets. How much assets did they take and how much money did they make off it? Now, if you look in 2015, the return on assets was obviously very bad. If you look in 2010, the return on assets was spectacular. If you remember in the slide where we talked about share buybacks, I told you that this thing is really cyclical. Well, look at it. It's really low in 2001, then it's great in 2015, then it's really low in 2008, and then it's great in 2011, then it goes down to 2015, and now it's going up again. And so that's what you need to understand, is this is a cyclical business. The difference, though, I think, in what's happened from 2015 till now is I think the company is being better run. They're gradually using their assets better and better. What that reason for that is they're disgorging all those assets back to us, the shareholders, in terms of dividends. And so now, in the last 3 years, they've been in the top 25% of companies. And I want to stress that that's really amazing, considering they're in a very capital-intensive business, right? It's very expensive to run mines. And despite that, they're in the top 25% of companies on return on assets. I think that's a sign this management's doing a very, very good job. I would be happy owning any company that's top 25% on return on assets. Even better when it's on the upswing and getting better every year. And this company has been improving for 7 years in a row. So I'm very comfortable with this issue for this company. A lot of people think return on shareholders' equity is more important than return on shareholders' assets. And the argument is that the net equity, if they can use leverage and use the bank's money to make money, so much the better, and that's better for shareholders because they're not tying up our cash. I'm just hyper conservative. I think that if you have too much debt and too much leverage, your company is always at risk, especially a company like this, which, as we talked about, is very cyclical. If you take on a bunch of debt in the good times, you're out of business in the bad times. So I'd like to discourage companies to take off. I like to discourage companies to take on debt. I think fantastic companies don't need debt because they're generating so many profits they can fund their own operations. So when they start borrowing money, I think that's a negative. Well, the benefit of taking on money is that you're going to have a significantly better return on shareholders' equity. Let's say you had, $1 billion in assets and $1 billion in debt. Now you have no equity. If you make $1 of profit, guess what? You've got infinite return on investment, but you haven't really done that much. You just got $1 billion of debt. So I give very little respect or very little concern to how a company does relative to other companies on return on shareholders' equity, because you're competing with a bunch of companies that are levered up too much. And those companies that are levered up too much in the good times are going to just kill it on return on shareholders' equity. And in the bad times, they're going to go out of business and they don't exist anymore. And who wants to be involved in industries where you can have this great company that one day doesn't exist anymore? So that's why I describe it and I discuss it, but I think it's less important than return on shareholders' assets. So one of the things that a company can do with its profits is they can retain earnings. That just means that they take a certain amount of their profits and they don't buy back shares and they don't pay off debt and they don't pay dividends. They just keep it. We're gonna use this for some of the business operations. Every company has that to some degree, and I don't mind if they do that. In fact, if they can get a spectacular return on those funds, I would prefer they retain all of their earnings. That's what Berkshire Hathaway has done. It's worked out great for their shareholders. But we need to figure out if they're actually using that money efficiently and effectively. And there's not really an easy way to do that, believe it or not, because we don't know what they've done with the money. And we don't know if the company would have performed just as well if they hadn't done that with the money. But in the aggregate over time, I think that you can measure to some degree this idea of return on retained earnings. But in this company's case, it's not really that big a problem because this company retains virtually no money. In fact, again, since 2013, this company's had negative retained earnings. They've made all of these profits, and they've done so while giving more than 100% of the profits back to the shareholders. That's spectacular. I mean, that's really, really good. If you can find a company that can retain no earnings, that means 100% of the money that they make, they can find a way to give back to the shareholders. That's a very exciting company. So we look at this company's return on retained earnings, and again, this is spectacular. Part of the thing is they're retaining virtually no earnings. And so when they're getting an increase in profits, it's just a spectacular return on retained earnings. But it proves the thesis that, again, if you can find a company that doesn't need much money, doesn't need to retain much money to fund its operations, and is paying off debt, so they're not funding their operations through debt, they're actually funding it through their business. And you can find a company that's getting a 200% return on retained earnings over 10 years. I guess I should backtrack and talk about what I'm doing here. So my method for calculating return on retained earnings is very imprecise and very imperfect, but it's the best thing I've been able to come up with. And what I do is I take 10 years of retained earnings, and I take 10 years of retained earnings, and I say, okay, that's how much we're investing back in the business. And then I take 10 years of earnings and say, okay, over those 10 years, we made X amount of dollars in the last 10 years, and we retained X amount of earnings in the last 10 years. What's that work out to in terms of a return on retained earnings? And this chart shows what that number is. And by the way, some of these years where it's negative, they weren't really negative. One of the problems with this process is if you have negative retained earnings and you have positive earnings, it's going to show up as a negative return on retained earnings, right? So I wouldn't worry about that. Long story short, this company does a spectacular job with return on retained earnings, in part because they're growing their earnings and in part because they're not retaining any money. It's a very long-winded way of saying that. So one of the things that's fantastic about this company, and one of the reasons I really like it, is since 2011, they've gone from about $5 billion in cash to about $15 billion in cash. So that sounds a lot like they've saved $10 billion. Now they've saved $10 billion. They're paying us a 10% dividend. They're paying down their debt, and they're buying back stock. I mean, what other evidence do you need that this management is doing a really, really good job? And they've even done that through a series of cycles, through good times and bad. This is just a great company, and I think you should own it. So this chart looks at every year. There's a bunch of squiggly lines here, and it's hard to follow. But what I've done is I've said, What has the company done in terms of reducing debt? Well, we know this company's reduced debt significantly over the last 10 or 20 years. What has the company paid in dividends? How much have they bought back in stock? What have they spent on buying back stock? What have they done to increase cash? I've taken all those numbers and I've said that I've created an annual wealth created. And then the orange line is those numbers cumulative over 5 years. And so this company has done just a spectacular job. It's creating $10 billion of shareholder wealth every year through all of these methods combined. And that's a great, great company. So that pretty much does it for looking at BHP's wealth creation. They've increased their cash. They've almost retained no earnings. They've grown despite retaining almost no earnings, they've grown their earnings. They bought back some shares. It's just a very, very solid company, and the management's company is getting an A+ from me. Thank you very much for your time.